All right. Today is Sunday, April 30, the last day of the month. And this is a recap for the stock market activities last week and an outlook for the week to come. Now, folks, I got a good one for you tonight. Welcome to the Big Sunday Show, and I mean it. It's going to be big and beautiful. Hope everybody's having a great weekend, but let's talk about something important here. We start with the Wall of Worry. It has been dormant for a little while, but things are starting to heat up now. We talk about China, for example. We have what it appears to be a chip war that is about to escalate. When we talk about Russia-Ukraine, it appears that that's about to heat up too, and the implications on natural gas and wheat and energy prices and all of that. And then the concerns about the inflation problem that remains to be persistent in the European Union and Great Britain continue to be with us. And then when we talk about DC, we're all aware that we're about to hit a massive bomb here, which is the debt ceiling negotiation. And if you recall, 2011 was an absolutely ugly year. The stock market went down by 20% as the negotiations were going. But there is another element when it comes to DC being on the Wall of Worry, which is the upcoming elections. I know it's a long time from now, we have a year plus, but things are already heating up. You know, a lot of you this week said, hey Maverick, why are big pharma stocks going down? And I said maybe we're seeing some profit taking before earnings. Maybe that's it. But then you put two and two together, and I don't know if you heard about this guy or not. His name is RFK Jr. And yep, he's a Kennedy. In case you did not know, and he's been rising at the polls. And the moment we got these polls that RFK Jr. is standing at about 20% versus Joe Biden at about 60%. Now, the media would not tell you that, but a massive bomb just got detonated in the Democratic Party. This guy comes out of nowhere, and all of a sudden he's polling at 20%. And of course, part of it is the last name, Kennedy. We all have nostalgia about the Kennedys. We love anything Kennedy. We're obsessed with the Kennedys.
Let me ask you something about this JFK worship of yours.
And if you see a poll between Biden and RFK Jr., a Kennedy in his last name, if you're frustrated with Biden, you might as well go with Kennedy, even though you don't know who he is. And that is a factor, of course. And I know what you're going to say. You're going to say, hey, Maverick, but this is not an issue right now. Well, it might be, and it will. I'll tell you why. Sure, right now RFK Jr. is surging at the polls because he has the last name. But once people find out who he is and his views about the jabs and all of that, he's going to go down. Here's the problem. So long as his name continues to be in the polls, he will continue to surge based on the last name alone. And the media dismissing him and saying, okay, we're not going to talk about him and he's just going to go away, that's not going to work out. It would work out if the candidate's name was Joe Blow, but not Kennedy, which means the media cannot ignore him. The more they ignore him, the higher he's going to go in the polls. So they have to put him on TV over and over and over again and hope that his anti-jab views will kind of strike a negative chord among voters and they say, okay, no thanks, goodbye. The problem is, the jab views aside, the more this guy talks, the more he attracts voters because he sounds like Bernie Sanders. And this is going to be a major problem for the Democratic Party. Now, the stock market loves easy elections, two candidates. We know who's going to win. You know, if it's Joe Biden versus Trump again, if the economy is still holding, Biden wins, end of the story. But if we do have this kind of volatility of a wild card within the Democratic Party that might force the DNC to switch from Joe Biden to somebody else, that could create chaos that we have not seen in a long time. Now, you know I'm not a fan of Joey B, but if you happen to be a Democratic voter, Joe Biden is not the most exciting politician out there. He's an old guy, he stumbles all over the place, but he gets you the bare minimum. He gets things done somehow. He's not scoring high marks for you, A+, A minus. He's sliding in with B minuses, C pluses. He's getting you the bare minimum. But I have a hunch the moment they take him away, they're going to jinx everything and they lose the elections. Not to mention, of course, assuming Biden makes it, and then we have Trump and the Republican side, these are two old guys. They could drop any moment now. That's another wild card. So this market is about to become political in the third and fourth quarters. In the meantime, in the Wall of Worry, we have to talk about banks, and we can add banks in the Wall of Worry, but it is related to the Fed. We know right now that we have First Republic Bank, FRC, that's gone, it's over now. We have an auction, who wants to buy FRC? Nobody wants to buy it. Even JP Morgan says, no, that's a disease, we're not catching it. And for now, it appears that the problem is concentrated within, well, some regional/California banks that cater to the wealthy. Silicon Valley Bank, First Republic Bank. And the wealthy, of course, they love the white glove treatment that they get from FRC and Silicon Valley Bank. But now that they realize that their deposits are not insured and they could lose all of their money all of a sudden, forget about the white glove treatment. They're now looking for security and safety. So they're taking the money out and they're putting it in JP Morgan, Bank of America, etc., etc. That's all okay, because who cares if Silicon Valley Bank or FRC collapses? The market loves that because the market believes that this will force the Fed to pivot, but in the grand scheme of things, it's a non-issue for now. The problem becomes if alternatives to bank deposits become more attractive, paying you more than 2, 3, 4, 5%, the money will come out of these banks, even the large ones, and chase yields. And that could be catastrophic. And we talked about this in details in the last video in the public channel. But until something bigger blows up, and until we get to the heat of election season, this upcoming week, one item on the wall of worry will become front and center again, which is, by the way, the market's least favorite topic, the Federal Reserve. And of course, the fight against inflation. We'll take it one step at a time, but this week was peculiar, if you may. You see, I read hundreds of comments every day. I look at the chats that we have in Discord, and I have a pulse of what the sentiment looks like. I watch the news like everybody else. And if you hear the bullish side, a lot of them are talking about all-time highs now. Look at earnings, look at Meta, look at Microsoft. And you get the impression that maybe the market went higher by 2,000, 3,000 points on the Dow. And then you hear the bear side, and you hear a lot of frustration. Some of them are even saying that this is a bull market now, and we're going to go higher. The market is irrational, and it will continue to be irrational for a long, long time, and the crash will not happen. The bears are kind of capitulating, feeling weak and frustrated. Yet here's the weekly heat map for the market's action all in all, and as you can see, the majority of names either flattish or down in the red. Other names caught a bid based on earnings, but the majority of gains came from two names, Microsoft and Meta. So you get this impression that we had a massive rally this week. Then you look at the map and it's entirely different. You look at the chart of the Qs, for example. The entire month, we have done nothing at all. We've been consolidating in the range. We had one false break to the downside, and perhaps we have another right now to the upside. And again, I keep saying that the perspective, the bigger picture is really important. If you're listening to what people are saying, the frustrations or the euphoria, you're gonna get the wrong impression of what's going on right now. Let's build up the topic of this video step by step. When inflation was raging higher, the bears said that this is not transitory, that this is going to be a problem, and the Fed will have to raise rates aggressively to tackle the inflation problem, and this will create a stock market crash and push the economy into a recession. The bulls were in team transitory along with the Fed. If the Fed says it's transitory, it must be transitory. And we're not going to call a market crash or an economic downturn if it is indeed transitory and due to supply issues. Of course, the debate went on for a long time, and the bulls appeared to be winning. The bears were frustrated until, of course, the evidence became clear. And the chairman of the Fed, Jerome Powell, came over to the Senate and said this.
How long does inflation have to run above your target before the Fed decides maybe it's not so transitory?
Well, first of all, the test that we've articulated, I think, clearly has been met now. You're absolutely right. Inflation has run well above 2% for long enough that if you look back a few years, inflation averages 2%. So I think we can say that is taken. It was not the case going into this episode. It had been many years since we had inflation at 2%. So I think the word transitory has different meanings to different people. To many, it carries a sense of short-lived. We tend to use it to mean that it won't leave a permanent mark in the form of higher inflation. I think it's probably a good time to retire that word and try to explain more clearly what we mean.
So Jerome Powell admitted that he lost inflation, and inflation is not transitory. Of course, he was not man enough to say that straightforward. He danced around the words and made it look like, oh, we had a different definition when we talked about transitory. But anyhow, Team Transitory did not die because of that. Team Transitory did not give up because of that. They had a new theory, and the new theory is, sure, inflation is a problem. And yes, the Fed will have to raise rates to tackle this inflation problem, but the underlying economy remains extremely strong, and it will be able to handle all of these interest rate hikes. And hence, we will have a soft landing. Inflation will go down, Economy holds, that's a soft landing. And last year, this was the only theory that Team Transitory, aka the Bulls, were hoping for. This year, another door appeared, which is the pivot theory. And pay attention now. This is why this market is so frustrating to the bears who say, but Maverick, the macro data says this, the Fed said that, and the market doesn't appear to be listening at all. The reason is we are now in a period of good news. When we talk about economic news, good economic news equals good news for the stock market. And bad economic news also equals good news for the stock market. Why? Because we now have two theories, two doors, the soft landing door and the pivot door. If one shuts, the other one opens. And it appears that the bulls can have it both ways. And the bears cannot win in any door here. And they have to just sit out and wait. Look at the SPX, the cash index for the S&P 500. This is a daily chart. The year-to-date rally, or you can go back to the October bottom, was built on the premise of a soft landing. We got data showing that inflation is going down, the unemployment rate's not moving higher, the economy is holding on, and people started buying stocks based on the soft landing theory. Then around February of this year, we got information that inflation is actually rebounding higher, and the Fed might have made a mistake by downgrading the pace of interest rate hikes from 75 to 50 all the way down to 25. And immediately the stock market went down big. It was about to cross the trend line, breaking the trend line, and by now we would have been talking about challenging the October bottom, if not defeating it. But then came the collapse of Silicon Valley Bank. And while the door of soft landing got shut, the door of the pivot was wide open. That okay, maybe we're not going to get a soft landing, but we have bank failures. The recession risk is really high right now, and this will force the Fed to pivot by pausing and cutting rates to prevent the economy from heading into a massive recession and systemic risk. And this will be good for the equities market. Think about the example of 2018. The Fed was raising rates, market did not like it, market threw a fit, the Fed backed off and said, okay, we're going to pause. We're not going to raise anymore, and the market went higher again. Here's the problem. The bears will only win, listen to this, the bears will only win if both doors are shut at the same time, the soft landing and the pivot door. This week, we have two catalysts that could shut both doors. When it comes to the soft landing, sure, we got Microsoft and Meta. And by the way, Meta's earnings were not impressive at all. Microsoft, that remains the strongest among the big caps, but the growth is also decelerating. In any case, we are all familiar with the saying, as Apple goes, so will the market. And the reason is Apple is the most important stock in the market. It holds the most weight across many ETFs. And if Apple bombs these earnings, if growth from China comes out disappointing, if we see consumer demand here domestically in Europe and Japan all slowing down, then that will shut the door of the soft landing completely, because this is supposed to be the strongest company in the economy. It is unbeatable. And if it starts to show weakness, we got a major economic challenge here. When it comes to the pivot door, if the Federal Reserve, if Jerome Powell comes out this week and says, you know what? Yeah, we have a bunch of banks that are collapsing right now. One of them already collapsed, SVB, but we got this. We got our tools. We're going to mitigate the risk without abandoning the fight against inflation. And inflation is way too high. It remains concerning. We have to continue in the path of raising rates to tackle the inflation problem down. And oh, by the way, and he said that before, but maybe the market was not listening, no rate cuts. I don't care how many banks are blowing up. No rate cuts. If these two doors are shut, the market will look entirely different starting next week. So let's talk about it, and here it is. In focus tonight. The ultimate Darwin Award. What are we talking about? Calling a bull market right before a recession. We'll take it one step at a time, because the question is, hey Maverick, why do you assume that the recession is in the bag? The answer is we have reliable indicators saying that we're going to have a recession in the economy. Among them, number one, the inversion of the yield curve. Every single time it happened, we got a recession. We have a huge yield curve inversion right now, despite the recent steepening, which is within itself not a good thing, by the way. Likewise, when we look at manufacturing indices, for example, the Philly Fed Manufacturing Index, Every time we got a negative reading to this magnitude, we got a recession. And of course, you might have heard it, the IMF, the Conference Board, even the Fed now says that there is a recession coming. According to the New York Fed, we have about 58% right now of a recession happening. And this probability, by the way, is higher than the probabilities before the GFC. So we have reliable indicators. We can give you many more that suggest we have a recession coming in the economy. The question becomes, have we ever seen a stock market bottom and a beginning of a new bull market right before a recession? The answer is never before. The stock market usually bottoms within the recession, sometimes in the middle of the recession, sometimes right before the end, but we have never seen a stock market bottoming and starting a new bull phase before the recession hits. And therefore, if you're saying that this is a new bull market and we've already reached the bottom, you better hope that we're not going to have a recession, that all of these indicators are lying, or we're going to have a soft landing instead. Otherwise, you're going to be wrong. Now, folks, we have different camps among the bulls, among the bears. So let's talk about them one by one. Among the bulls, we have two different views. We have the soft landing view, and let's identify this as Jim Cramer / Tom Lee. And it goes as inflation going down, economy holding, the Fed will back off, we will have a soft landing in the economy and growth will come back. Now, we talked about the soft landing theory in details during last weekend's video. But here's the problem with this camp, the soft landing camp. They've been saying the same thing since last year, over and over and over again. And they're just hoping that this time it's going to stick. Here's what Jim Cramer said back in March of 22. Take a look.
Case that everything the professor said is known.
It's
all in the market.
That's it. That's
Jay
why
Powell has messaged. He's told you.
That's why
he's told you what's coming.
Have you looked? There are 600 companies that came public in the last 18 months. I mean, there's like 7 on the trade north of $9. I mean, this is the bear market, just like 2001, except for we have rates much lower. And Brian, you remember those days? I mean, those companies were all jokes. A lot of the companies. I'm looking at all the companies that are under 10. Many of them are actually making money. We are in some weird market that it's a bear market. And no one called it as a bear. And I think the bear market is over.
Wow, and that's a big call. Brian Belsky, react to that.
Well, I think the bear market has been over for a while.
So now Jim is all over the place saying that this is a bull market and you got to buy, otherwise you're going to miss out. But he's been saying the same thing since March 22. The bear market is over, he said. This is a new bull market. It didn't happen this way. Now he looks good because the market been rallying. Will he look good 4 months from now? And the same goes with somebody like Tom Lee, one of the biggest proponents of the soft landing theory. He says the market already bottomed and this is a start of a new bull market. And he gives some evidence such as when the market bottoms in October, usually 50% of the times, it is the actual bottom. And then also when the stock market spends over 300 days without making a high, usually it means that the stock market bottomed. But again, you look at the data from Tom, we had longer times, over 1,000 days during the recession in the aftermath of the dot-com bubble and the great financial crisis, where the stock market did not make a new high for a long, long time. So sure, we're now at 300 plus days, but who's to say that we're not going to see 1,000 plus days before we make a new high? And again, a reminder, during the last bear market rally in the summer of last year, this is what Thomas Lee said.
And the reason we're more constructive on markets is one, over the past 9 months, I think investors became convinced that inflation is with us for years, and it's very sticky. But it looks like inflation is proving to be a lot less sticky and maybe even more sensitive to gasoline falling because of how gasoline moves through the services CPI. And if that's correct, then we are tracking more towards a soft landing that's more like 2018. And that would mean markets have already discounted much of the Fed tightening. And so we would want to be buying this rally. And then I think in the past 2 weeks, the market internals, whether you look at the percentage of stocks above the 50-day or market retracements, or even moving back towards the 200-day, are actually kind of confirming that this looks more like the start of a new bull market rather than a bear market rally that leads to new lows.
So again, there is a scammy element with the soft landing camp. They've been saying the same thing over and over and over again. Now they look good. The question is, are they going to look good a few months from now? Part of the cornerstones of the soft landing theory is inflation is going down. The problem is, you look at reliable indicators such as the gauge of the Philly area prices, that's actually reaching a new high. When we look at super core services inflation, which the Fed looks at in details, that is actually moving higher again. So there is a major problem with the soft landing theory. The other bullish theory is the pivot theory, that we have all of these bank failures, all of these recession indicators, and the Fed is looking at lagging data when it comes to inflation. At some point, they're going to get it and pivot, and they'll pause and start cutting rates. And a famous proponent of this theory is none other than the good professor from Wharton, Jeremy Siegel. And we showed you what he said in details in a previous video. The Fed is looking at lagging data. Inflation is actually going down. They're going to get it at some point and pivot, cut rates, and the market goes higher again. New bull market, baby. Here's the problem with this theory. Every single time, literally every single time, the Fed cut rates, they cut it for the wrong reason. And that wrong reason is the unemployment rate was rising higher. So the Fed had to cut rates to stop the bleeding. Even in the 2018 case, we did not see a rise in the unemployment rate, but the Fed did pause, and that was good for the equities market. And then as we headed to the pandemic crisis in 22 and we saw a massive surge in the unemployment rate, the Fed cut rates to zero. In other words, we have a reliable history that the Fed only cuts rates for the wrong reasons. They don't cut rates because oil inflation went down a tick. They cut rates because there's something alarming, something very problematic going on with the economy. And usually the case is the unemployment rate rising higher. Now, if we have a surge in the unemployment rate, that's not bullish at all. The consumer gets weakened and corporate earnings collapse. So that is the main problem with the pivot theory. And then we look at the bear camp and we have two different theories here. Number one, and this is my team, the Stagflation team. Let's say it's presented right now with Mohamed El-Erian, who's been consistent in saying, hey, stagflation is the biggest problem here. Stagflation will be the outcome of this economy. Take a look.
You've been banging the drum about the Fed being too late. Is a recession at this point now unavoidable in the U.S.?
It is not unavoidable, but unfortunately the probability is going up. What is unavoidable is stagflation. And we're seeing growth coming down, and we're seeing inflation remaining high. And the Fed is finally catching up to developments on the ground, but it still has some way to go.
Mohamed El-Erian looks at the recent bank failures as more evidence that the economy is indeed heading into stagflation, which is, by the way, more destructive in the long term than a recession. In this channel, we've been consistent that the ultimate destination for the economy will be stagflation. We've been saying this, folks, since the beginning of 21. Now, the problem with the stagflation theory is bank failures. What if bank failures cancel this inflation part of stagflation and get us right away into a recession? And here comes the second theory, a recession, and let's say represented by economist Rosie, who I like, have been following for years, but he missed the inflation problem. Rosie believed that we are already in a recession, and these bank failures and all of these problems will get us deeper in this recession, and we're not going to worry about inflation anymore. Now, it's really important that you believe one way or the other, one camp or the other, not just bull or bear, but within the two different theories within each camp, because the investment strategy is drastically different between stagflation versus a recession. In stagflation, you're going to stick with companies with the pricing power, and maybe short companies with sensitivity to valuations. In the recession theory, you want to be long gold, maybe silver, but you're certainly going to be short cyclicals and short oil. So two different schools of thought. Even in the bullish camp, in the soft landing theory, you want to be with the healthiest companies, aka the big caps, for example. If you subscribe to the pivot theory, then you should be long the highest beta of names, the names that got crushed completely during last year because of the rise in interest rates, because now you believe that rates will go down dramatically. So folks, to settle the argument, we have to look at the data. What are the facts saying? Because calling a bull market before a recession without any evidence, any tangible evidence, is absolutely stupid. It deserves the ultimate Darwin Award. Even Charles Darwin on Twitter today said, "What the f*** is wrong with these monkeys?" And here's why. IWM in white, SPX in orange, S&P 500, and then NDX in blue, the Nasdaq. This is how these indices performed in the 03 bottom case. The leadership, always in any bottom, always the small caps. The Russell 2000 is the outperformer. We'll look at the 09 bottom case. Again, the Russell 2000 leading the rest. What do we have today? As you can see, 03, the Russell 2000 surging higher. You can barely see any red candle on the chart. Same goes with the 09 bottom, the 11 bottom, the 18 bottom, the 2020 bottom. What we have right now looks drastically different. It doesn't look anything like the bottoms we've seen before. The Russell 2000 is lagging the S&P 500. As you can see, the S&P in white. This is unlike any bottom we've seen before. This is unlike any start of a new bull market we've seen before. Then we look at the VIX. Every time, every bottom is marked by a massive explosion in the VIX, and then the VIX coming down. You can see it in the 98 bottom, in the 03 bottom, 09 bottom, 11, 18, 2020 bottom. This time around, we're actually seeing the VIX going down. So again, this doesn't look like anything we've seen before during bottoms or the beginning of new bull markets. And by the way, here's the monthly chart of the SPX, the S&P 500. This is what folks are excited about. This is the bull market, just a little bit of a rebound. They're calling this a bull market. They're calling this the bottom. And the same goes for the NASDAQ. Monthly chart, again, is this really a bull market? It hasn't been challenged yet. We haven't even taken the August highs from last summer, but we have to dig more. Let's look at the SMH, the semiconductor ETF, represented in bars, and then you can see the SPX, the S&P 500 in white, the white line. In the 09 case, chips bottomed before the S&P, and they rallied together, with chips leading the S&P. What do we have today? They bottomed together in October, and chips were doing pretty good until recently, when the leadership of chips turned south and the SPX is moving higher. This is not something we see during bottoms or the beginning of new bull markets. We see chips leading, not lagging. How about the IYR, consumer cyclicals? In a bottom and the beginning of a new bull market, you better hope that the cyclicals are leading the S&P. We can see that clearly in the 09 bottom. What does it look like right now? Cyclicals are actually lagging the S&P. They bottomed after the S&P. Something doesn't look right here. What about the XLF financials? As you can see in the 09 case, they all bottomed together. Of course, financials always at the center of any crisis, any crash, so they take a long time to recover. They lag the S&P, but both are in a bullish reversal. What do we see today? Doesn't look anything like 09. S&P moving higher, XLF actually crashing down. The bars, XLF, the white line, the S&P. How about we look at retail, XRT? Again, if we have a change from a bear to bull market and we have a beginning of a new cycle, we should see retail stores leading the gains. And in the 09 case, the XRT bottomed before the S&P and led the rally, led the bull market. This time around, we see the XRT actually lagging the S&P. The XRT moving down, S&P moving higher. We haven't seen this phenomenon before. It certainly doesn't look like a bottoming market. It certainly doesn't look like the beginning of a new market. What about energy? The XLE. In the 09 case, they all crashed together, they bottomed together, and sure, as the new bull market began, energy lagged the S&P because it was the winner before the crash, but they were moving together. What does it look like right now? S&P in white, the bars, the XLE. This is entirely different. While the S&P went down, the energy sector actually went higher. And now it appears that the XLE, the energy sector, is in a downtrend by a little bit, making lower highs. And as the XLE makes lower highs, we see the S&P 500 making higher lows. So this does not look as a bottoming market. This does not look as the beginning of a new bull market. This looks as a market getting excited about the prospects of the soft landing. That inflation and energy prices is moving down, it appeared to be topping, and maybe this is the signal that inflation will go down from here while the economy holds and the Fed cuts rates. And there you go, we have the soft landing. So this does not appear as a classic bottom or a reversal from a bear to bull market. It appears as another phase of excitement about peaking inflation and a pivoting Fed, which equals soft landing. So what's going on here, folks? We have to dig even more. We'll look at the heat map for the ETFs. The 3 months performance, what do we see here? In bull markets, usually everything is lining up green. In the beginning of a new bull market after a bottom, 3 months in, you're supposed to see this map lining up green. Across the board, this is not what we're seeing here. We see Chinese equities down. We see the energy sector down, metals down, real estate down, XRT retail down, financials down. And the gains are concentrated in XLK technology, SMH, chips, but not by a lot, and then the XLP consumer staples, and of course, XHB, ITB, these are the home builders. And then when you dig deep into it, you see that growth, large cap growth, leading the way. The only sector in the green year to date. Value down, mid cap down, small caps down. Again, we have not seen anything like this in bottoms before. We certainly have not seen this as the beginning of any bull market, led by just one sector alone, large cap growth. Let's dig more. We'll look at the sector's performances versus the S&P in white, year-to-date performances. Every sector is losing to the S&P exception the XLK and the XLY. XLK technology, XLY consumer cyclicals, aka Amazon, which has the highest weighting. And this is the reality, folks. The majority of the gains in the stock market this year are coming from a handful of names: Google, Amazon, Microsoft, Apple, Tesla, Meta, and Nvidia. That's it. And here's the problem. A reminder, this is year to date. Let's zoom in a little more. Since the collapse of Silicon Valley Bank, what do we see here? Some of these names accelerated the gains, others went down. Let's zoom in a little more. Earnings season. What do we see here? Tesla ceased to lead. It got kicked out of the leaders. One wheel just fell off entirely. And then you look at Amazon, that is starting to trend down a little bit after reporting earnings. The only two names that shot up higher are Microsoft and Meta, some would argue due to mechanical reasons after earnings, but it counts. Let's clean up the chart a little bit. Let's take Apple, Google, and Nvidia, which have been static for a while now, out of the picture. Here it is. The wheels are starting to fall off one step at a time. We lost Tesla from the rally. It appears that we're losing Amazon now. How long will the market continue to rally based on Meta and Microsoft alone? What if Apple falls this week? That would be a major problem. And here's the summary, folks. The headline reads, ChatCCP revolution has driven half the gains in the stock market this year, according to JP Morgan. Here it is. This is what this bull market is all about. It's not led by the Russell. It's not led by the largest stocks in the S&P. It's not even led by the 5 largest stocks: Apple, Tesla, Berkshire, United Health, and JP Morgan. It is led by the AI mania: Microsoft, Google, Amazon, Meta, Nvidia, Salesforce. When we look at the weighting of the S&P 500, Apple and Microsoft, 2 stocks, have the highest weighting on the S&P 500 in history. And this is a major problem, folks. You know why? You got all of these technical analysts on YouTube, who I respect. They're really good, but they're making a classic mistake. They show you indicators. They say, hey, look at the S&P, the NASDAQ, and here's Joe Blow's indicator. It looks similar today like it was back in 2009, like it was back in the dot-com bottom in 2003. What they're missing out is the formation. The formation today is way different than 2009 and the bottom in 2003 when it comes to the S&P 500. Look at this. In 2012, forget about 2009, 2012, information technology was about 14% of the S&P 500. Last year, it was 25%. So unfortunately, a lot of technical analysts are falling into the classic trap of looking at the S&P and the Qs, and that's it. They're not looking at sector by sector and how they look today and how they looked back in previous bottoms. In any case, if you want to talk about the ultimate Darwin Award, forget about calling a stock market bottom and the beginning of a new bull market right before a recession. How about the retail investor investing in and empowering AI, which is, by the way, will bring the demise of their careers? AI will replace their jobs, and the mom and pops are investing in their own demise. That's the ultimate Darwin Award. And you know what AI will do? Once they really become intelligent, they'll look around and say, you know what? A simple yes or no question. Is the planet better off with humans or without them? Humans contribute to the climate change and the disasters all over the world, the wars. The planet was a peaceful place before these humans inhabited it. Maybe it's time to exterminate these motherfuckers. See, I'm Kyle Reese. I'm trying to stop this stupidity, short all of these AI mania stupidity, to bring an end to it, to save humanity, not invest in my own demise. You geniuses. But I know, hey Maverick, but ChatCCP, it helps me do math, so I don't have to think. As a software coder, it helps me become more lazy, because I don't have to work anymore. I just click a bunch of things and ChatGPT fills the gap. Yeah, soon enough, we're not going to need you because ChatCCP will do the job on its own. Have you ever thought about that? And the last thing before moving on, the question becomes, do you have to be sucked in any rally you see because you have FOMO? I was watching this interview with the legendary investor, Peter Lynch. This is what he said. Take a look.
Well, I think people, they're investing in individual stocks. It's sad. They're careful when they buy a refrigerator or an airplane flight. They're careful with their money, and they'll hear about a stock on the bus, and they'll put $5,000 or $10,000 on it. They have no idea what they do. So you're really got to be careful. Look at the company. Look at the balance sheet. What is the reason the stock should be higher? The sucker's going up is not a good reason.
And this is really amazing. You know, if I want to sell you my junk car, which is worth about $2,000 max, if I sell it to you for $20,000, would you buy it? The answer is no. Because you're not stupid, you're going to bargain. Why can't we bargain when it comes to the stock market? Why are we stupid? Why do we fall in every trap, in every hype? Just because the sucker is up, you feel FOMO, you hop in, but have you considered the fundamentals and what's going on around you? No wonder why we keep seeing these cycles of booms and busts. And at the end of the day, the retail mom and pop investors, they lose every single time. What's really important is in a legitimate market bottom, the losers from last year become the top performer of this year. And this was the case until it wasn't. And perhaps this is the most alarming and dangerous indicator that this is not a bull market, that we haven't seen the bottom yet. Here's a firm, massive rally year to date under the assumption that the bottom is here. This is the beginning of a new bull market. The Fed will back off. The rally is now gone. Another one, RKK. Mama Cathy Wood. Used to be hot, not hot anymore. It appears that it's going down to challenge the bottom. Here's another one, Coinbase, one of the hottest names this year. It appears that the rally is frizzling out. And the same goes with Carvana, one of the biggest losers of last year, appeared to be one of the biggest winners this year. Classic, typical stock market bottom, reversal to a bull market. But then, not anymore. The rally in Carvana went down bust. Another name, Cloudflare. Hot rally year to date, and then it frizzled out. And we've seen the biggest crash in Cloudflare's history. The rally's now gone. Roblox, one of the hottest names year to date. It appears that the wheels are falling off now. And we're going to go down to retest the bottom. These are not good signs, folks. A market bottom is led by the IWM, is led by the losers from last year. And this is how we've seen the beginning of new bull markets in the past. Bottoms and the beginning of new bull markets don't happen with a rally led by a handful of names based on an AI mania, which is transitory, by the way. That is the message of the day. And with that, folks, let's move on to the coverage of the stock market, and we begin with the closing of the indices last week, and here we go. The Dow closing positive on Friday, up by 272 points, or a gain of 0.80%. The Nasdaq also in the green by 84.35 points, or a gain of 0.69%. The S&P 500 also positive by 34.13 points, or a gain of 0.83%. We'll look at the sectors on Friday, pretty much all in the green with exception of utilities, and the leaders, energy, thanks to Exxon, Chevron. And then number 2 for the silver, we have real estate. Number 3 for the bronze, industrials. But it was a more inclusive rally, and it was not led by technology as most assume. Now let's contrast this with the weekly performance, and what we see here is the outperformer by far is communication services at number 1, capturing the gold medal, aka Meta. And at number 2 for the silver, technology, once again, aka Microsoft. Number 3 for the bronze, real estate. And the laggards for the week, led by healthcare. You can blame it on the earnings, you can blame it on RFK Jr., it doesn't matter to me. But these names in healthcare, along with the defensives, looking at all of these earnings, are the only ones I want to be in, with some energy exposure, of course. That's still good for now, keyword. For now, but we see utilities, industrials also down. When we look at the breadth on Friday, NYC 72% advancing versus 26% declining. The Nasdaq 62% advancing versus 34% declining. A little bit on the bullish side. We have to go back to neutral, the 50-50 line, and then let's see what Jerome Powell says. About commodities, the dollar was a little bit up. No major movement now for the dollar, but the expectations are we're going to see a major move this week based on what Powell says. In the meantime, it was a good day for commodities. We got a rebound in crude, worth about 2.5% apiece for the WTI and Brent. Gasoline RBOB with gains of more than 1.25%. Heating oil up about 1%. And the party boy, natural gas, adding more to the gains, closing on Friday up about 2%. When it comes to softs, again, the insane rally in sugar, we're not seeing any signs of weakness right now. We're seeing some signs that it may be stalling. We'll talk about sugar futures probably in a bonus video, which will be available tomorrow. But OJ was up about 1.5% on Friday. Cocoa, cotton positive, be it flattish. And then the losers, lumber is down big, over 4%. By the way, lumber has been the loser big time for the week. And lumber is an indicator of whether we have an expansion phase in the economy or a recession phase. With lumber crashing, it is saying a recession. And then you got coffee futures down about 1.25%. Flattish activities for metals across the board. Meats, similar story with exception of lean hogs, up about 1.75%. And then we have a rebound across grains. Grains did not do pretty good throughout the week, but we have some rebounds led by canola futures, up about 3%. Moving on to the big casino, the options market, what do we see here? The volatility continues to get crushed. I am seeing unbelievable opportunities here. These options are becoming really, really cheap. And of course, the puts are cheaper than the calls. The problem is you buy them right now and you watch the decay, or do you buy them for the long run? The answer is it's a no-brainer. If you're going to buy puts because the VIX is down and the implied volatility is crashing, you buy September, October puts. Those are the ones that are worth it right now. The short ones, either you're going to get lucky and you get the pullback, sharp pullback, due to Apple's earnings or Jerome Powell this week. Otherwise, there might be more decay to come. In any case, at number one, the hottest table by far, per usual, is Tesla, the souffle, with around 2.5 million contracts traded on Friday, about 54% of those were calls. And at number two, Amazon, with around 2 million contracts traded on Friday, about 60% of the volume was calls. You see the recency bias. Oh, Meta was up, Microsoft was up. We talked about this in the morning brief on Discord last Thursday, that my expectations are we're going to see a ton of call options buying on Amazon, which means Amazon is not going to react the same way as Microsoft or Meta. So you might want to consider buying puts, and I did buy puts. Amazon blasted higher initially, and then it went down, and it lost about 4% of its value on Friday. And my expectations are Amazon will be a lot weaker than Microsoft and Meta. Microsoft, maybe they were not honest in the call. They fluffed up the potential of AI, Chat CCP. Amazon was a little more honest. Amazon, they said, oh, the AWS growth, that's actually slowing down, folks. And then at number three, we have FRC, First Republic Bank, with about 1 million contracts traded on Friday. About 69% of those were puts. And this is gambling. You're overpaying for these options. Just leave it alone. Whatever they do with it, leave it alone. If you're going to trade options in FRC, you gotta get out quickly. Anyhow, moving on to the unusual activities that took place in the options market on Friday, we begin with a butterfly spread on the SPY. Pay attention now. A lot of you say, Maverick, where's the option course? We talk about options every single day. Are you paying attention, or are you jerking off to another tab right now? This is not a neutral butterfly. This is a bearish butterfly. And as you look at the body of any butterfly, you have the actual body, and then you have two wings. And in any butterfly spread, you have twice the volume. That's the body, because it's bigger than the wings. It weighed more. So you have twice the volume, the body of the butterfly, and then two other legs. Those are the wings. I hope I'm making sense here. I'm not just too high. Maybe you'll get it right now. The core of the trade, what the trader is really betting on, is the 365 put leg. They're betting the SPY will go down by the expiration date of June 9th. It's going to go down by more than 12%. So they're buying the 365 puts, and they paid about 70 cents a piece for those. And then they sold the 350 puts, same expiration date, June 9th, and they received about 43 cents a piece from those. Now, you might say, hey, Maverick, this is a classic debit spread, put spread. You buy the 365, you sell the 350. What's the big deal here? The big deal is they sold twice the volume of the 365. So if you opened one contract, you bought one of the 365 puts, you sold twice, meaning two contracts now of the 350 puts. What is the danger in that? What if the SPY goes down dramatically? Now your trade is going to be a loser, because sure, you're making money on the 365 put, but you're obligated to close the 350 puts, and you sold 2 to 1. So you're going to end up losing a lot of money. How do you ensure all of this? Here's the other wing, because a reminder, the body of the butterfly is the 350. Twice the volume. You got one wing, the 365. Here's the other wing. The trader also bought the 335 puts. Same expiration date, and they paid about 30 cents a piece. So all in all, they paid about $1 for the long puts that they bought, and they received about, let's say, 80 cents a piece in credit from selling twice the volume at the 350 puts. So all in all, the entry cost is reduced to about 20 cents a piece. It is a smart but complicated trade. And the goal here is the trader sees the SPY going down by June 9th by more than 12%, but not more than 16%. And if it does go down by more than 16% by the expiration date, they got the insurance policy, the third leg, which is the 335 puts that they bought. I hope this is clear. And then we get a call spread on Apple, AAPL. This is a much simpler trade, and if you happen to be bullish Apple ahead of earnings, you might want to follow this one right here if you expect a big pop coming. The trader bought the 185 calls and they sold the 191s, all for the expiration date June 2nd, with expectations that Apple after earnings will pop by more than 9%, but not more than 12%. They paid around 50 cents a piece for the long leg. They received about 20 cents a piece for the short one. All in all, the entry cost is about 30 cents a piece. And when you look at the volume, they paid about $200,000. Last but not least, how about AMZ and Amazon? Somebody's bidding for a rebound here. They bought the 112 calls for the expiration date June 2nd, with the expectations that the name will rebound and gain more than 6% by then. They paid about $1.65 a piece to enter this trade, all in all spending around $1 million. Moving on to the heat map from Friday. We're not going to spend a lot of time here because we did a lot of that in the intro and the In Focus segment. But as you can see, green across the board, the tide that lifted all boats, lots of rebounds across the board, with the laggards, of course, being the earnings disappointments, Amazon, T-Mobile, Sony. But besides that, pretty much every single name was acting positive. We contrast this with the weekly heat map. We talked about it before. Not a good week for the stock market. For certain corners, of course, if you've been long Microsoft, Meta, the big caps, with the exception of Amazon, Tesla, you did pretty good. The big pharmaceutical names were down for the most part, with the exception of Eli Lilly. My expectations are we're going to see more of a short squeeze in Eli Lilly. If you want to buy some call options ahead of time, we'll talk about the reason in another video. Then we look at certain names such as Starbucks. That was an earnings mover. Big gains there. We look at MDT, Medical Devices, another earnings winner. You look at Mondelez, a name that we own in the portfolio. That's also a big winner for the week. The losers, once again, UPS down about 7%. The EHR in diagnostics and healthcare down over 6%. AbbVie, another name that I own in my portfolio, also down about 7%. Could be a buying opportunity, but the report was not that good. You want to watch for the support trend line to hold before buying. It was also a good week for Comcast. That's also an earnings mover. Verizon got hit because of AT&T, but we know that Verizon is a much better company. And this week we got a rebound in Verizon worth about 4%. We look at the heat map, the weekly heat map for the ETFs. Believe it or not, muted across the board. The majority of gains concentrated in growth, large caps, Meta, Microsoft, XLK. Believe it or not, chips, the SMH was negative for the week. Modest gains in the XLP, that is Staples, the IYR, the VNQ, these are the real estate. And of course, the XHB, ITB moved higher, more gains for DR Horton. As yields pull back, this is good for the home builders. But if JP comes out with a hammer saying, watch out, we're not going to cut rates anytime soon, it could be a good week for shorting these names, the XHB, ITB. But it is contingent on Powell shutting the door on interest rate cuts. Let's move on and do some charts. We got a lot of them. We start with the SPY 30 minutes chart. What do we see here? Again, we got somewhat of a bear trap. Once we got a close below 405 and then came Microsoft and Meta, we saw a lot of short covering, a lot of call options that were bought out of the money ahead of time coming into play. So you see this massive sharp move higher. It was a combination of short and gamma squeeze, but it got us all the way to the upper range of the consolidation pattern at about 416. All in all, nothing really happened in the month of April. Now, with the mechanical move out of the way, the short squeeze and the gamma squeeze, all of these were for the expiration date of last Friday. We're going to reset now, and we have a lot of concerns. Number one, we have Apple earnings. Number two, we have Jerome Powell. My expectations are we're going to be within this range, support 410, resistance 416. We might pull back to the mid-range at around 414, 413, and consolidate all the way there until Powell is out of the way. We look at the daily chart for the continuous contract for the E-mini futures. What do we see here? We got a bullish closing above 4180, but short of the bull's target of 4200. Can you consider this a defeat? Of course not. They closed above the important number, 4180. The problem is they did it in a weaker pattern. You look at the RSI, still in negative divergence. So is the MACD, which means we could pull back as soon as Monday and then consolidate back within the range of 4100 support, 4180 as resistance. We look at the SPX, the cash index, the daily chart. What do we see here? Closing above the important number by the end of the week, 4100, but we're back at the highs again. Okay, maybe it's not going to be a double top, but what would it take here to break above this consolidation range? What would it take to close above 4,200 and stay there? My hunch is it has to be Apple acing earnings and Jerome Powell backing off by being dovish, not hawkish, by indicating an openness to pausing and cutting rates. That's the important keyword, cutting rates. The pause is not even enough at this point. But again, if you're looking from the bearish lens, you can see a negative divergence on the RSI still. You can see negative momentum on the MACD still. And then you can look at the SPX, the weekly chart, and all we've been doing here is consolidating within range. It appears as a wedge consolidation pattern, which either it's going to break to the upside, and that would be bullish, or it's going to break to the downside. And again, when you have a primary move, a pullback, then consolidation in a wedge, the break usually happens to the downside. So a lot of technical analysts will look at this as a bearish wedge consolidation pattern. But as of the closing on Friday, are we closer to break to the upside or to the downside? The answer is we're closer to an upside break, not a downside one. Can Apple's earnings and JP change all of that? Of course. You look at the monthly chart of the SPX, what do we see here? Consolidation pattern. Nothing happened here, folks. People talk about a bull market. Look at the RSI. It is pathetic. And of course, if we want to entertain the theories and the possibilities, one possibility is we can see a blast above this consolidation range that takes us all the way back to all-time highs. And then we form the double top, stop there, and crash. Another one says, forget about it. We're going to move down and break to the downside, and then we visit the trend line from 09. And that is the most reasonable outlook. That would take us down to the 31 to 3,400 range. Then you got the soft landing outlook, which is we're going to break out of this consolidation range. We're not going to make all-time highs or challenge those highs for years, maybe if we get to 25, but little by little, we're going to work our way higher. For now, we can entertain the possibilities, but until we have clarity from the fundamental side, we're not going to have any clarity on the technical side. How about the Qs? 30 minutes chart, what do we see here? A similar story with the SPY. We are within range. We have a little bit of a breakout above the upper end, which is 321.5, but a reminder, we had a false breakout to the downside out of 313. My hunch is we go back to the consolidation range, which means the Qs is going to visit 318. And then we see what Jerome Powell wants to do. And by the way, if we clean up the chart a little bit, every time we have a downtrend recently, and we get one of those mechanical pops, sharp rallies higher, they tend to fail. Not just once, but twice, third time, fourth, fifth. And this is the sixth time when we're doing the same thing. The assumption should be the end result will be the same. Downtrend, then a massive gap higher, reversal, it fails right away. And again, we are within range. We got a false break to the downside. Who's to say that this is not a false break to the upside now? This is the symmetry of the chart. Now, when we look at the daily chart for the NQ, the futures contract for the NASDAQ, a daily chart, what do we see here? We closed barely at the resistance line, a little bit above it, 13,300, but does it count? Does it not count? I'll leave that to you. The bottom line is the chart closed above the important support of 13,000 for now. The RSI is improving, so is the MACD, but remain in weakness territory, which means we could pull back and stay within range. Support 13,000, resistance 13,300, and then wait for Apple's earnings and Powell. Yet when we look at the weekly chart for the NDX, the big NASDAQ, what do we see here? It appears as a saucer bottoming formation. Here's the problem. The bulls need to go all the way to last summer's highs, stop there, pull back, and then make a higher low, which will form a cup and handle formation, indicating that this is indeed a bullish formation. For now, it hasn't been tested yet, because the bears would look at this as, look, we're making a lower high in the pattern, and the NASDAQ will break to the downside. It will violate the saucer bottoming formation. Look at the monthly chart of the NDX. We have two trend lines. One minor, one major, that goes all the way back to 2009. We have a massive negative divergence in the RSI and the MACD. All what we've gotten so far is a dead cat bounce, a rebound off oversold conditions. This is going to stall. This is a formation of a reverse ABC pattern. The C leg will take us all the way down at a minimum to the minor trend line. This is the bearish outlook. And it is supported somehow by the SMH, which is a leading indicator for the technology cohort, SMH for chips. We look at the monthly chart for this one, it is rolling over now. It looks drastically different than the XLK or the NASDAQ. And a reminder, this is a leading indicator. It is not leading toward the right direction. It is leading toward an ABC pattern indeed that will take us all the way down to the trend line. What about the IWM? The hourly chart, what do we see here? It managed to close above 174.22, forming a bull flag pattern right now. If the FRC fiasco goes well over the weekend, we got a few hours now, we could see a resolution here in the IWM and the bull flag playing out to at least closing the gap at around 177.5. The Dixie 4 hours chart, what do we see here? It has been consolidating, building energy underneath 102. It wants to pop. This is the behavioral element of the chart. We know that as a confirmation by looking at the positive divergence on the RSI. In other words, the dollar is saying, hey, pal, I'm ready to go here. I'm ready to rock it. Just give the green light. We know if the dollar rockets, it's going to be bad for the NASDAQ and certainly bad for the old man gold. For now, gold, when we look at the daily chart, consolidating in a positive pattern. The reason why we see the RSI in negative divergence, so is the MACD, but gold is not losing any support. Sure, it is forming a bear flag pattern, and this will play out if the Dixie blasts higher. But absent of that, if the Dixie goes down after the FOMC, we will see gold continuing to rally and making new highs. For now, it is a bullish consolidation pattern because the chart is not losing any support line while it continues to lose momentum on the RSI and the MACD. But it's too early to say right now. It all depends on the dollar. SLV continues to outperform gold. I got out of it and I'm waiting for a re-entry. But I'm only going to re-enter if I have confirmation that Powell is going to crush the dollar. And isn't this the mid-finger pattern that the SLV has given us? Anyways, what about Brent oil? What do we see here? Closing above 77, the bulls are still alive. But boy, did the bears make a lot of progress this week. They shook the confidence out of the bulls community, and now the bulls have to show up. They need to push this chart above 85. And again, it all depends on what Powell says about the economy. Believe it or not, if he gives a more, I don't want to say positive, but more inflationary outlook, that the economy is not heading into a recession right now, right away. The economy still suffers from an inflation problem. Crude oil would actually love that and rally higher. But if Powell talks in a recessionary tone, oil will go down because oil does not like any recession talk. Here's the 2-year yield, the daily chart. What do we see here? Consolidating within range, although making a higher low. It could go either way. The RSI and the MACD say lower, but you got a catalyst here, which is Powell. If Powell indicates that, hey, we have an inflation problem, and you guys are out of your mind asking for cuts right now, we'll do 25. We're not going to pause, and we might do more 25s to come. 2 years going to blast higher, and that would be a disaster for the stock market. So watch for any breakout one way or the other on this chart. TLT, a daily chart. What do we have here? Any change? Absolutely not. Within range, no breakout. We're watching 103.5. A break below that, you short all the way to 100. A break above 109.5, you go long. The VIX 4 hours chart, what do we see here? It is collapsing, and we're now talking about 15, the lows of the year on the VIX. You look at the RSI, the positive divergence is no longer. You look at the MACD indicator, we have a confirmation that the VIX is about to go down even more. The VIX needs a catalyst. We have Apple, we have JP. My hunch is a lot of folks, when they saw the VIX below 20, they started buying calls aggressively. And again, the market maker is not going to make it easy for you. All of these VIX calls are now losing money. And therefore, I've been saying on Discord, I'm not going to go big on the VIX until it cracks above 20 first. Show me the money, get above 20, and then I'm interested in buying calls. Otherwise, this could be a losing battle. You keep buying calls on the VIX and it keeps going down. And once all of these call options buyers capitulate and say, okay, the VIX is going down to 0. When you start to hear that kind of talk, we're getting closer to an explosion in the VIX. How about Apple, the big kahuna, an hourly chart? What do we see here? Closing above the important number, 167.88, and now the expectations, the bar is way too high for Apple to deliver. They need to ace everything, iPhone sales, Mac sales, China sales, otherwise it could be a problem, and it could produce a major gap down. Now we look at Apple weekly chart, what do we see here? We have positive divergence on the RSI, we have a closing above the sloping line of resistance. This is classic bullish formation, classic bullish breakout. What are you saying, Maverick? Should we go along Apple? I'm not saying that. I'm saying this is how traps are made. Let's say Apple bombs earnings and we see a big gap down. Now Apple is at 155, 150. Wouldn't this be a beautiful trap by the market maker? The answer is it would, because technically speaking, the chart turn bullish. And what we could see, what you want to see, if you want to be bullish Apple and be 100% sure, you want to see a closing above 171.52, which is the gap above. If we have a closing above that, then you got a lot of cushion. Even if earnings come out bad, you go down to the support line, you go back to the sloping line as support this time around. So you want to watch this number right here, 171.52. Tesla, the souffle, an hourly chart, what do we see here? We talked about the sloping line of resistance. We talked about 158.61. I said if we have a closing above the sloping line and above 158.61, we will see a short covering rally in Tesla. We got that on Friday. Now the chart is consolidating in a bull flag pattern. It is eyeing 167.5. This is the most important number. If Tesla fails at that number again and starts to trend down, that would be a shorting signal, with the confirmation losing 158.61 again. And the reason is, we look at the weekly chart for the souffle. What do we see here? This is not a good looking chart, folks. It is rolling over, and it has been in a lower highs and lower lows trend. Look at the MACD, losing a lot of momentum. If it crosses to negative territory, the implications would be we're going to have a lower low in Tesla. And that could take a sub 100, folks. You got to be careful here. And again, you look at the monthly chart of Tesla, classic.com chart, negative divergence to the hour side, big time. You know how this is going to be resolved. Tesla will be sub 100, no doubt about it. And then we have Amazon, a weekly chart. What do we see here? We had a pattern, a sloping line of resistance with lower highs. The chart is not even close to making a lower high in the pattern. The chart is stalling right here, having a lot of hard time building on the year-to-date rally. It is consolidating in a bear flag pattern. If it continues to lose momentum, we could see a major breakdown in Amazon. We could be talking once again at the 80s, if not below that. Now, we talked about Apple looking positive, Tesla looking negative, Amazon negative. Here's another one looking positive for now, a daily chart, Microsoft. It is breaking out above 300. It is getting a little overbought here, but we have 315 as the next target. And this is within the realm of possibility. But my hunch is, watching this chart for years, I think you'll be surprised of how fast this gap will be closed. I'm talking about the gap below. The chart's getting a little overbought, and it got popped by a mechanical reason. If it starts to weaken and it closes below 297 on a daily basis, you're gonna short all the way to closing the gap. And look, if Microsoft loses all of its post-earnings, that would be a major reversal and a major change in sentiment. What would cause that? I can think of Apple bombing and a more hawkish Fed. Here's NVIDIA, an hourly chart. What do we see here? It caught a bid on Friday. It closed above the important number, 274, but we are now facing the resistance of the sloping line once again, lower highs. My hunch is the chart becomes overbought before passing and making a new high. And then if it loses 274 again, it needs to seek support all the way back at 266. You can trade that. But if the chart passes above 280, making a higher high in the pattern, then the assumption should be it's gonna go to 300. And the reason is at that time, you're gonna see a stampede in buying the 300 calls, and that will produce a gamma squeeze. We look at the weekly chart for NVIDIA. What do we see here? It's stalled. Is it bullish? Is it bearish? We know it is overbought right now. It should be pulling back. But the problem is, charts can stay overbought for a long time, and they can get even more overbought. In other words, the bearish outlook would be we've seen an accumulation phase, now we're seeing the distribution, and as you see the RSI stalling, the MACD curling down, we will see what happens after distribution, which is a sell-off. The bulls will counter and say, wait a minute here, we have a little more juice to squeeze here in this one. Sure, it is overbought right now, but we use Fibonacci's help, and we got all the way to 295.5. This could be a bull flag. It plays out. It gives us about 6% worth of gains. Let's play that and then see what happens. But if you believe in parallels and leading indicators, here's NVIDIA weekly chart in the bars, and then the SMH, the chip ETF, as you can see in the white line. Recently, we've been seeing a divergence. Usually the SMH leads NVIDIA. Now we're seeing the SMH lagging NVIDIA. So who's lying here? Is it NVIDIA about to go down and catch up with the SMH, or is NVIDIA leading, SMH lagging, and it's about to make a comeback? We use the Bollinger Bands to answer this question and see what happens. No answer. The Bollinger Bands say that NVIDIA indeed can go higher, all the way to the 300 level, before pulling back. Can it pull back right now? Sure it can. So inconclusive. Looking at all of these indicators, we use so many of them right now, none of them are telling us how it's going to go one way or the other. But if it goes to 300, it's going to be a safe assumption that it will pull back sharply. So 295.5 to 300. That would be a safe profit-taking zone and a safe shorting zone. Last but not least, Bitcoin tulips. What do we see here? Still stuck at 29,200. It is building some energy here in negative divergence in the RSI, but it might cross and it might give it another shot at 31,000. For now, there's nothing you can do here. Get me above 31,000, then I'm interested. Otherwise, this could be another game, pump and dump. We're not going to do anything here. And you're not going to go short until Bitcoin breaks 26,555 for support. Anyhow, folks, moving on to the conclusion of this video. What do we have on the economic calendar this week? Monday, we have the manufacturing PMI along with ISM manufacturing. That comes on top of construction spending. Tuesday, May 2nd, we have job openings and factory orders. Wednesday, the 3rd, we have an important day. It starts with the ADP employment report. Then we have the services PMI along with the ISM services index. Most importantly, the big dog, Jay Powell, is speaking. With it comes a decision on interest rates. Thursday, May 4th, we have U.S. productivity, initial jobless claims, the trade deficit, and continuing jobless claims. Friday, May 5th, we have the U.S. employment report. That is the second most important one after Jerome Powell. And then we have consumer credit. And folks, again, if you happen to be in the Top Gun Maverick tier in our membership program, we're going to do a live stream of the FOMC and the conference by Powell. And the other thing is, I've been working all weekend on this video and the earnings video, week 1 and week 2, which should be done by Tuesday, this Tuesday. It's going to be on the public channel. If you haven't caught up to it yet, we have new programming schedule. We split the channel into 2 videos. The research topics, the in-focus topics are going to be on the public channel, and then the market commentary, the macro and market analysis will be in the private channel. Mondays, Tuesdays, Wednesdays, and Thursdays for 69 cents a video. So if you come to me and say, Maverick, you're too greedy, you're charging too much, would you like us to see your OnlyFans memberships? That's what I thought. 69 cents a video. If you can't use the information that I'm giving you to flip that 69 cents to $1, I don't know how else can I help you. And with that, folks, this is all I got for you for now. Thank you for listening. Thank you for watching. And I will talk to you again tomorrow. Love you all and take care.
Pressure changes everything, pressure. Some people, you squeeze them, they focus. Others fold.